Institutional market participants are currently monitoring a critical liquidity inflection point on the US30 1-hour time frame, where price action is tightly compressed between major structural boundaries. The broader macroeconomic narrative and institutional footprint demonstrate a sustained bullish recovery following an aggressive expansion phase from the 51,500 region, establishing consecutive breaks of structure toward higher multi-week highs. However, immediate price delivery has encountered heavy institutional supply, triggering a localized consolidation phase right around the 53,780 mark. This compression leaves market participants positioned directly between key structural imbalances, requiring absolute precision before committing capital while carefully assessing upcoming market volatility and institutional order flow across major sessions. Our primary operational focus centers on the structural demand matrix situated between 53,620 and 53,720. This immediate decision zone represents the primary foundation for the continuation thesis. Our focus is on this entry zone. We are waiting for mitigation here. Once price action confirms, we can expect the move to start. Upon successful mitigation of this institutional footprint and subsequent internal structural confirmation, market expansion can target clear liquidity pools resting above the 54,000 threshold. For the primary bullish trajectory, Scenario 1 targets liquidity clearance at 54,200, designated as T1. Scenario 2 looks for continuation toward the major structural supply cluster spanning 54,500 to 54,700, designated as T2. Scenario 3 represents the macro expansion phase, targeting the psychological 55,000 and above handle upon a sustained structural close. Conversely, if institutional supply at 53,900 to 54,050 heavily defends, an alternative bearish delivery model comes into play. Under this alternative distribution framework, failure to hold the primary structural floor initiates a downward sweep targeting T1 at 53,300, T2 at 52,100, and T3 at 51,400. This shift requires strict adherence to our risk parameters as momentum accelerates into lower liquidity pools, testing the strength of foundational macro demand structures while market participants re-evaluate positioning across changing time frames, managing unexpected volatility shifts during corrective impulses. Targeting T1 at 53,300, T2 at 52,100, and T3 at 51,400. Risk mitigation remains paramount within these volatile institutional frameworks, protecting capital through strict structural discipline. Our invalidation level is strictly set at 53,620. If price breaks this, our bias changes. A definitive hourly breach below this threshold invalidates the immediate recovery model and shifts structural control to bearish participants right now. This is an educational video, not investment advice. Follow for more. The next analysis is coming very soon.